All right, so this is the followmetrades.com new earnings strategies rollout. Again, we launched an earnings trading strategy last quarter. It did really well. We learned a lot, and we've added some new ways to play earnings, and we're going to roll out those new strategies in this session here. So I'm Dean Jenkins, founder of followmetrades.com, if you don't know me, if we haven't met. And then I've got a guest presenter who's working with me here today. It is Mark. So Mark, maybe say howdy.
Good morning, everyone, or afternoon, depending where you happen to be.
Yeah, we do have people from all over the world calling in. So about a year ago, I started talking about in the trading room about that I was doing research, trying to work on an earnings strategy. And Mark raised his hand and said, hey, I'm working on one too. You want to compare notes? And we did. And we were working on very, very similar things. So we joined forces, and Mark has been working with me. And he brings a lot to the table in terms of analytical skills and math skills and programming skills. And so we were able to, again, join forces and come up with a pretty decent strategy for trading options, and it's been really fun. So before we dive into it too deep, just a quick reminder, hey, all trading and investing involves risk. And everything I'm talking about here is for education, information purposes. I am not a financial advisor. I'm a trader. So I'm just sharing ideas about what I do. What each person does, is each person's decision and responsibility. So I'm not giving financial advice. Everything's for education, information purposes, and I'm sharing what I'm doing. So here's the, I said last quarter we launched a earning trading strategy. So we had been doing testing throughout the year and trying different things and, tuning the approaches and the formulas and all that kind of stuff. And finally in October, really with the start of the Q4 earnings season, starting with Fastenal, we locked down the process. We did live market testing. So this was just Mark and I, and we got a really nice profit in that week. And then I did a free trial week where we opened it up and people could come follow along with the trades. We had a good week that week, and then it became a paid service, and we did really well in the first week that people paid for. They got a really good value. And this was really the peak of earnings season. And then you can see, we continued on with kind of mixed results. And the trades we've been using to date were based on straddles and strangles. And if you don't know what those are, we're going to explain it in just a moment. But you can look at this chart and go, maybe you should just trade the first month, right? But what the deal is here is, this was when the peak volume of earnings was going on. At this point, you have literally on a given day, hundreds of companies, sometimes up to 1,000 companies reporting to choose from. So you get to take, the very, very best trades, the best of the best. But there are other trading opportunities. And as earnings season tails off, right, you maybe have 10 companies reporting or 20, and you got fewer to choose from. And, the potential in a straddle or strangle trade, if you don't have as many candidates to choose from, it may be, this one's okay, but maybe not great. And so it really drove us to add some other strategies because there's always opportunities, right, beyond just the straddle strangle. So, here's the basic premise of trading earnings is that earnings announcements can, cause big movement in the underlying stock. And the lead up to the fact that earnings announcements an earnings announcement is coming, it can cause the expectation of a large move in the underlying stock. And that typically is seen not in the underlying shares itself, but in the implied volatility of the option contract rising when there's an expectation being priced into the options of a big move coming. So we have profit opportunities, based on these realities, based on this scenario, where a big move is expected, but it's not fully priced into the options. And so we have algorithms and ways of doing that. Mark's going to give you a quick glimpse of his spreadsheet as he presents, that we've really tuned to identify the probability of a big move. And then if we see a pricing advantage where it's not fully priced in, we can go take advantage of that simply by buying straddles or strangles. We can also sometimes determine a directional bias that we think, there's a objective data-based reason why at earnings a stock would go up or down, and then there's some buy strategies for that. And then there's a big move expected but it's already priced into the options, right? And so you wouldn't want to take a straddle strangle position on that, because even if the expected move happens, you're not going to make a profit. You're going to lose money. But there is some strategies, selling, buying, some, spread variance there. You can make some profit on that. And then if there can be a move that's predicted, but it's going to stay within a known range. It's not going to be a big move. There's some opportunities for profit there. We're going to walk through these different scenarios and how we deal with it. So, hey, some more folks have joined. And that's I scheduled this for 8 o'clock Pacific time this morning, 11 o'clock Eastern. Based on the events last night, the president is supposed to be speaking here at the same time. Mulvaney didn't check with me, the White House chief of staff. If there had been a conflict, they probably would have moved that if they'd known. But yeah, there could be some market movement, based on the press conference at the White House. But we're here and we're just going to press on. And hey, welcome Barack. Hey, Dale, glad to have you here too. We got some exciting new stuff. So this is kind of the premise for earnings trades. And here's some of the things we learned. And some of this we knew already. We just want to reiterate some things are new that we learned as we rolled this out last quarter. And the first thing is just so important. Risk management just has to be respected and incorporated on every single trade. You have to. The first question on any trade, whether it's earnings or something else, is how much could I lose? And the answer should never be more than 2% of your trading account. And in earnings, ideally, we're going about 1%. And then the reward to risk ratio must be on our side. It must be greater than 1 to 1. And ideally, we like 3, 4, or 5 to 1 reward to risk ratios, but we never take trades that have the potential to lose more than they would make. And your straight credit spreads always have a terrible reward to risk ratio. It's always 1 to 4, 1 to 3, something like that. So I'm not a fan of those. Straddles and strangles work best when we have a large number of candidates to choose from, and we can take the best of the best. And this occurs during the peak announcement. And of course, we're looking for, the probability of a big move and then a price advantage in the options, where if the move happens, we will make profit. If it's already priced in, then you got to use a different strategy. And that's where we adding buy and sell strategies. It increases the trade candidates that we can trade, decreases risk. And, on many candidates, this is going to be better. And that's what we're going to introduce today as some new strategies. And then the next thing is managing open trades is an art, right? You really cannot fire and forget, right? And as much as we would like to, we cannot script a black and white, step-by-step, what do you do after the announcement, right? Because it's situational. And it depends on the individual trader, whether you're at your computer, what indicators you like to use, if you're away, right? Every trader has a different situation, and every post-announcement chart is going to have a different presentation. So there's a bit of an art to it, and each person, brings, approaches that a little bit different way. There's profit available with a variety of trade management techniques post-announcement. So we just learned that trying to provide a detailed black and white script, it's kind of a losing proposition. We'll never be able to cover every scenario or cover every person's situation. What we can provide is algorithms and filters that identify top earning trades candidates. We have formulas that identify the best option strategy for a given trade. And we can provide precise entry criteria for trade entry, including risk management and pricing. And then we can provide some broad guidelines for managing the trades. And we have, a really good dynamic community in the earnings trading room each morning, Monday through Thursday, who are sharing tips, tricks to manage and maximize profit and minimize risk. So there's a place to gather, share ideas. Mark and I share ideas. The traders in the room share their ideas. So there's a place to get information. But again, we can't provide detailed black and white trade management exit signals. It happens too fast. It's situational, and each trader has a kind of a different take on that. So that's some key learnings. And then here's just some things that we've learned and are important to if you're going to trade earnings, these are some things you just need to embrace, right? And that is, if you're going to succeed as a trader trading earnings, right, options are the way to do it, right? You need option approval at your broker to buy and sell options, right? Different brokers have different definitions of what's level 1, what's level 2, 3. You need the ability to buy and sell options, right? Not, and we never ever sell naked option positions, puts or calls. So selling naked positions is, typically a next level beyond being able to participate in spread type trades where you buy and sell at the same time. But you need to check with your broker and be able to buy and sell spreads. Okay. You need the ability, both the skill and the understanding of your platform and of options, and the availability to manage the open positions during the regular trading session, right? Options don't trade outside, pre-market or post-market. They only trade during the regular session. You need the willingness, and I call it the DNA level acceptance of risk management. You have to embrace the idea that, some trades you're going to lose on earnings, right? And if you look back at our track record here, right, our win ratio is, less than 50%. We're still profitable, right? We ended up with a really, really nice profit, but less than half of the trades won, right? The winners are bigger than the losers. We get that by embracing risk management and controlling how much a trade could lose if it goes wrong, because some of them are going to. And then you have to be willing to pass on a trade if the pricing guidelines are exceeded. If it ends up costing too much, we're going to publish it ahead of time. If by the time you're ready to place the order and the price is moved and it's too expensive, you got to be willing to let it go. Right? There'll be more trades. Right? So you're guaranteed to fail as an options or earnings trader if you ignore risk management, if you take entries outside the price guidelines, if you expect or need step-by-step hand-holding. I don't mean that to be derogatory, right? But if you're just not at the level where you can competently and comfortably manage trades and positions, right, it may not be a good strategy for you. And you're guaranteed to fail if you lose track of positions, you get assigned, you hold naked short positions, right? If we're taking, some version of a spread, butterflies, iron condor, or something like that, and you close the long side and you're holding the short side, you are naked and you could take a very large loss, right? And so if you do that, you're kind of guaranteed to fail. You get away with it once in a while, but you will eventually get bit, okay? So these are just some reality checks about trading earnings and whether it may or may not be a good fit for you. So currently we use straddles and strangles, and they're great in the right situation. We're going to introduce some new strategies here today, and you can see the list here: strip strap, long gut, straddle, strangles, iron condors, double diagonals, calendar spreads, and butterflies. And so we're going to walk through these one by one. Mark's going to start presenting, and what we're going to do, this is not intended to be a primer on advanced option strategies. It's really a quick view of what these different strategies are, how they work, and then we'll talk about how we employ them in earnings, okay? So if you're not familiar with options, and if this starts to go over your head a little bit, we're not here to, again, educate people on advanced option strategies, but really to talk about the advanced option strategies that we're going to employ on earnings, right? And there's good resources if you really want to learn about this. Go to Investopedia, look these terms up, because they have great definitions and explanations and examples for you, right? Yeah, we are recording this, and assuming all the technology works, we will get the recording posted, and I'll make this presentation available in a PDF as well. All right, Mark, I'm going to hand it over to you, and if you would briefly walk through these various option types, and we'll try to field questions as we go. Again, we're not going to get too deep into, trying to train people on options, but rather to explain what we're using and how we'll use it.
Okay, so on each of these slides, there is a explanation of the type of trade. I'm not going to go into the detail of what it is, but it talks about the construction of the trade, what the potential profit is, what the risk is, and those types of things. You can go through this and pour through it, or as Dean said, go to Investopedia and take a look at what these do. This is what we have been doing, which is a straddle. You can go to the chart. And basically it is, we're playing both sides of the trade. We're looking at a put and we're looking at a call, both at the money, and we want it to move in a direction, a violent direction. We don't care which way, up or down. and we get profitable at a certain point. If you look at these charts, you will see where it crosses the center line on all of these charts, there's a little red tick. That's your break-even point. So the stock has to move to the price that's at the bottom. Stock has to move to that price and through it in order for the trade to become profitable on any of these charts that we're looking at. And then we can go to the strangle. On a strangle, very similar trade, except we're buying an out of the money call or put. We're giving ourselves a little bit of room, but very similar construction, limited risk, maximum profit. And if you notice, the difference between this and the other one is there's a little bit of a dead zone in the middle where it's flat, where you're going to realize your maximum loss on your trade is going to be in that flat spot. Anything that moves outside of that flat spot, you're going to start recovering some money. And again, when you get to the red ticks is where your break-even point is going to be on this trade. A strip. Strips and straps are variations of a straddle. And basically what we're doing is we're coming up with a directional bias. In this particular case on a strip, we're thinking that the directional bias on this stock is going to be down. So we are going to buy twice as many puts as we buy calls. It allows us to participate if it moves against us, but we can profit more if it moves in the direction that we're looking at. And if you'll notice, the little red tick moves in a little bit more to where we are so that we don't have to have as much of a move in the direction that we're looking at in order for it to become a profitable trade. Obviously, if it goes against us, it has to move a lot more in order for us to become profitable, but it gives us a way to be able to manage and when we see a directional bias in a particular stock. A strap is the same thing, except we're going on the other side. I may have typed this wrong, but it says two puts. I think it's two calls on this particular one.
Yeah, I just caught that as you were talking. Let me just make a quick edit, and we'll have that fixed.
The chart is right. The description was wrong.
All right. Let me just edit this on the fly. And then there we go. Back to screen share. There we go.
All right. So we're on this one, we're looking at an upward bias on the thing. We're going to buy twice as many calls as we buy puts in this particular one. And you'll just see the reverse of what we saw in the last one, is that if it moves in our direction, we become profitable more quickly. It takes us a little bit longer to recover if it moves against us, but it's the way that the trade works. A gut is a strangle, basically, but what we're doing is we're strangling with in the money calls and puts. So we're looking at it, and in some of these cases, it has to do with implied volatility or lack thereof, in which it makes the trade more profitable quicker for us. If we do that, we'll lose less on one side, make more on the other side. That's what this particular strategy does. And what it does is it looks very much like a strangle, but if you were to look at the strangle chart, what it's actually done is it's moved up our risk aspect of it. So we lose less because we're buying in the monies. So there is the potential to lose money in the middle. There's that little flat zone, but that has actually moved up on the chart so that you're going to lose less. And again, all of these have to do with when we look at the option, where it's priced at, what are the spreads, those types of things, whether we employ the strategy or not. Now we get into the real, I shouldn't say complicated, but more intense type of trades that we look at. An iron condor is basically a variation on a straddle strangle in which we're buying both sides. We're selling an out of the money put, and we're buying an out of the money put, and we're selling an out of the money call and buying an out of the money call, which gives us a zone in which we make profit. So in this particular case, this would be a strategy in which we're looking at a stock to not move much at all. It's going to stay in a zone, and our profit is going to be right in that area if the stock does not move. So we're looking to capture something. Example would be something like a consumer staples like a Clorox or P&G or something like that that doesn't typically move a lot, but we're trying to capture something. The risk reward has to be there. That goes into what Dean was talking about, the 1-to-1 or better type of scenario. So this type of trade doesn't happen very often, but it can happen if the risk to reward is there.
And so, Mark, on this chart, on this P&L chart, it'd be good to point out, right? These all have a defined risk, which meets our criteria, right? We know exactly what we could lose. But on these, sell type, there's a max profit, right?
Correct. You're capped on both sides.
Right. And this one, has a max profit of $200 and a max loss of 300. So it's here to demonstrate, the shape of the trade, the P&L. But we wouldn't take one that could lose more than it would make.
Correct. But to keep it even, if you notice, all of these charts are based on HELE, which is a symbol that I used, just to show you the different trades, different strategies with a single stock at a given point in time. And these are the things that we look at. And so this one would be thrown on the scrap heap, so to speak, because it, compared to all of the other trades, is not one of the more profitable ones. But I wanted to keep all things the same from a perspective of looking at the same symbol. But these are things that we look at when we're defining what the trade could potentially be, is we look at all these different strategies and which one makes the most sense for the particular equity that we're looking at. And then there's basically the buy side of the condor, in which we are buying an out of the money put and selling one closer, and buying an out of the money call and selling a higher strike and a lower strike that are out of, and it actually flips that entire chart around from a perspective of where it is.
And I want to address a couple comments that came in. One, there was a question about recording. Yeah, we're going to record this and publish it afterwards. And then Dale was saying, hey, the font here is too small to read. We really are trying to show the shape here, and we will publish this presentation in a PDF where you can look at it and see it on your screen and be able to actually read the stuff. All right.
And so this particular condor trade is that if this stock does not move at all, you're going to lose your maximum amount of money. If it does move outside the parameters, then you're going to be capped on what your profit is. So any type of move whatsoever that would be outside of what we're thinking, you're going to hit your maximum profit and you're going to stay there. And it doesn't matter if the stock goes to zero or it goes up to $1 million. This is how much money you're going to make, and that's all you're going to make, and it's capped at that particular point. Your max loss is going to be right at where we have the strikes at that particular point in time. So if the stock moves nowhere, you're going to see maximum loss. But we're not taking candidates that aren't going to move. We're looking at, there's a different trade for that, which was the previous one that we would take in that particular case if we thought it wasn't going to move. But if we thought a stock was going to move, and we look at being able to capture that, what this does is it reduces your cost of the particular trade so that you can get into a trade for a lower amount of money. But what you're doing, you're trading something for that. What you're trading is you don't have unlimited potential. You have a limited amount of profit that you're going to make on the trade.
Yeah, that's a good point. That because you said, hey, you need the thing to move outside the strike range here to make profit. And one question would be, well, if you need a move, why don't you just trade the straddle strangle? And you answered that question, is this will lower your cost. Sometimes the straddle strangle positions are very expensive, and this is a way to lower the cost, but in doing so you cap the potential profit. And this example, HELE, right, just before the call, Mark and I were talking, he goes, hey, this actually is a candidate that we're looking at to trade here very shortly. And the straddle position would cost you $1,200, but this would cost you $60, right? So that's a huge difference, and a reason why you would come to this strategy. Well,
this particular trade would be based on where I took the snapshot as a $7 trade. It's reduced, so it'd be a $700 trade to get into this particular one. The one we were talking about is one that's coming up, which is a butterfly.
Okay.
And a double diagonal. Now this one is, you're not going to get a lot of information on this screen because of the nature of the trade. What you're doing is you're selling a call and a put at the closest, nearest expiration, and you're trying to capture implied volatility. So what we're looking at is we're going to say, okay, implied volatility is high. We're going to sell an option on a near dated option. And what happens is as soon as they announce, IV collapses. And so the theory is that that sold option becomes less valuable. And so we were able to capture the money that we sold. And then what we're doing is we're buying further out in time a call and a put, in essence, creating a pseudo strangle. And we're using that money that we collected to finance the longer positions that we're looking at. It's tough to quantify because if you get a violent move on something, all of the stuff moves into the money. The problem is you have different expiration dates, and so the deltas are different. And so trying to figure out what your profit and loss is going to be is it's an art, as Dean had said before.
Right, but you do have a defined risk, right? You can know what your
absolute defined risk is always the difference between the strikes. So if we had a $5 spread on it, you're going to collect some money. You have a $5 spread. So the difference between what you collected and the $5 spread is your risk, period, end of story. Everything that we have has a defined risk on it.
And Bill's saying, could you explain this last line?
Okay, so the last line is, in the short term, when the trade is on and we're in both sides, you have limited profit potential and limited risk. What we want to try to do in managing this type of trade is get out of the short positions as quickly as we can. So for instance, we collected the money, we get a slight move, not a violent move. And what happens is the two options that we sold that were out of the money become worthless. And so what we want to do is buy them back for pennies on the dollar. So we could theoretically buy them back for a penny or 2 cents. And we get out of the short positions. As soon as we're out of the short positions, it becomes a long straddle strangle. So we are only in the long positions with a further out expiration. And now we have time for that stock to move in either direction for us. And the profit potential, once we're out of the shorts, becomes unlimited because it can move and continue to move. And we're not being penalized by being short on any position.
Right. You said short, but it's the long positions. We're only in the longs.
We're only in the longs. We've covered. We've bought. In essence, we've bought to close these short positions.
Yeah. And here's an example. CALM is one that I took this type of trade on, right? And now all I'm holding, I dumped all the short ones and immediately dumped the long call, and now I'm only in the short or in the long put, and then. This one you can see after earnings typically has some follow through. So I'm trying to let this thing ride, and all I've got is a long put, and it's continuing to increase in profit. And at this point, it's unlimited potential.
And so this is where it's tough to be able to define. Everything here shows in profit because it's trying to calculate the near dated versus the long dated. And it's saying, oh, gee, you can't lose any money on this trade, but that's not true. Your defined risk will be the difference between what you collected and the difference between the strikes that we take. That's your risk of where it is. Ideal scenario here is to get in the position, use the shorts to finance the position, and get rid of the shorts as quickly as you possibly can, or the sold puts and sold calls.
Right, and that goes back to that point we made. Never sell the longs. You sell the shorts first, right? You never want to be naked on the short side.
Correct. Yeah, you absolutely not. And then there's the butterfly construction, which we're staying on one side of the trade. There's so many variations of a butterfly. I just used 2 different examples of buying and selling for this, but you can construct. There are tons of names. There's ratio butterflies. There are unbalanced broken wing butterflies. There's all different strategies, and it would just take so many slides to describe the different ones, but we look at each individual trade. So this is a standard butterfly in which you're buying one call or put, you're selling two calls or put, and you're buying another to cover you call or put, and they're all the same spread, same expiration. So if you're doing a $5 wide spread, say you're buying a 100, you're selling two 105s, and then you're buying a 110. That's the construction of how a butterfly works. And so in this particular case, when you're doing that, again, if the stock doesn't move, that's where you're at max loss. If it moves through what you're doing, then regardless of how the trade comes out, you're capped at what you're going to win, regardless of which side this particular trade works out on. And that's a sell side one, not used real often because of the risk reward. It's got to be there. There's got to be tons of IV that's built into the particular trade. On a buy side butterfly, there's a very defined area. The ideal scenario in this is that we look at the predicted move of the stock and say it's going to move X, and that's where we set up our strikes as to what we do. And the ideal scenario in this is that the stock moves to that strike price, and that's where it is at expiration, and that's where your maximum profit is achieved at this point. But you'll see the advantage to this trade as to where the zero line is, what your investment is, and what your potential profit is above it. So the ideal scenario in this has a multiple to one type of scenario if we have the trade set up correctly, in which we have the predicted move, we get the predicted move, and it expires at that particular strike that we are at. Anything outside that range is where you're going to see the maximum amount of loss. So this is a trade constructed in which you have a small amount of capital in it, and you're looking for an exact thing to happen.
And like you said, a rare trade, but worth showing, right?
Yep.
And to address Samson, I may have used the wrong term. I messed it up, but yeah, when you got the short option positions where you sold to open, yeah, the terminology is you buy to close. So if I messed that up, that's good to clarify.
Correct. You're selling to open, and then what you're doing to cover that position is you're buying to close.
And then Samson's asking, you can see his question here. For the butterfly, would you trade the closest expiration?
In a butterfly, that is the absolute best way to do it, is that you're looking at, and ideally these would be something that trades weeklies. So we would be looking at something, for instance, HELE reports tonight, I forget if it's tonight or tomorrow. We would look at January 10th expirations this Friday, because what we don't want is, we don't want this type of trade to be out there in February, because there is so much potential for movement trying to pick that, and then there's time value built in and those types of things. What we want on this type of trade is time value to erode on us as quickly as possible, and we want it to be at those strikes. So in essence, that the short positions expire worthless, and then the other positions expire at maximum profit. And so the critical piece on this is to close this position prior to expiration so that you are not assigned or exercised on this particular position. So if this scenario were to happen, it were to move there, you were at the exact peak of this particular thing, what would happen is Saturday morning, or actually after the close on Friday, that would be exercised on you, and you would be long the stock position. So you want to be able to avoid that, get out of this position prior to the close on the expiration day.
And Samson's saying, I think down here in the contract section, it shows a debit. I think part of the screen's cut off, right? There's a net credit on this trade, and that's where the profit is, that credit.
This one's a debit in which you're actually buying it. The previous one is the credit that you would get. So the butterfly that's on the flip side, you'd get a credit for.
Oh, okay. I'll be quiet.
And so this is a summation of all of those charts and what potentially may happen in these particular cases for this particular stock when I did this snapshot, which was, I believe, Sunday. So the prices obviously may have changed since that point in time, but it kind of gives you an illustration as to what you would have in, what your max loss would be. where you would need, what type of move you would need in order for it to become profitable on any one of these trades.
Yeah, we're not here to walk through this. It'll be in a PDF that you can download and study. But the point is, as we evaluate trades, this is what we're looking at, a table like this, to see which one's got, the best risk to reward and which one makes the most sense for that particular equity and the conditions for it.
So we haven't changed anything in our methodology other than refining some of our algorithms, but we're using the same algorithms to identify our candidates. The difference in these strategies is that we looked at, when you looked at that P&L chart that Dean put up, we were trying to, I don't want to say force the issue, but we were looking for trades and we were looking for the best candidates. And in some of those cases, there would have been a different strategy that would have worked better on some of those candidates that we had. And so that's why we're doing what we're doing. But we screen the same way. We look at the best of the best as far as what we're doing. And then we look for the type of strategy that makes the most sense for a particular strong candidate in order to maximize profit, minimize risk.
So you want to show your spreadsheet real quick, just how you sort and filter?
Sure.
Okay, I'll give you the screen.
So a lot of this may not make sense to you from a perspective. It makes a lot of sense to me. This is this week, actually, companies that are reporting this week into Monday. And you'll see that we had Constellation Brands and WBA reported today. Lennar also did. I don't know if it's on, oh yeah, it's on here as well. And so we look at these candidates and we look at expected moves, what we think the directions are, and all of these algorithms that we have built into here tell us what it is. Bottom line, when I look at it, you can pay no attention to the stuff that's already happened because green is good, yellow is okay, and red is bad. So the example that I will give right now is Bed Bath & Beyond is reporting tonight or tomorrow morning, I forget which one, but they are going to report. If you look at it, pretty much everything's red across. It's way too expensive from the perspective of where the option is. So we look at that, and that would almost that absolutely disqualifies it for a strangle or a straddle. There's just no way that stock would have to move over 16% for us to even break even at this particular point as to what we're looking at. So we would look at it and see if there's a different strategy, but based on what I'm looking at on this, that one just gets thrown into the wastebasket. We're not even going to look at it because it doesn't make sense. We're not going to try to force a trade on that particular one. We're looking at things that give us a good cost ratio on the percent of the contract. And then the other thing that we're looking at is different ways to construct trades. So if you look at Helen and Acuity Brands, which is AYI, both of those are within the zone. They've got lots of greens and yellows, look like really good trades. But if you look at it on a strangle, the HELE would cost us $1,135 to enter the trade. And the Acuity Brands would cost us $1,200 to enter the trade. So we would need a move of over 6% and almost 8.5% in order for us to break even on that trade. So that's what these new strategies do, is they allow us the opportunity to be able to get in those trades at a lower cost basis, but still be able to capture profit on those so that we're not sinking as much money into a trade. It also helps us out in the really high flyers, the Amazons, the the Googles, the $1,000 stocks where it would cost you, we had some trades in last earnings where it would cost you $6,500 to get into a straddle. That's just undoable. But some of these strategies allow us to be able to participate in some of those trades. While we're limiting our upside, we can still participate in moves that happen, and that's the purpose of the strategies that we're doing.
And Bill's saying, hey, don't see IV on the spreadsheet. Do we account for it? IV is reflected in the price, Bill. It's in the price, right?
If you look at my calculation sheet somewhere on here, there is implied volatility right here. So it's calculated into the particular things that you're seeing on the main screen. So this takes into account IV into the calculations of the moves that we're looking at.
And my point, IV is reflected in the contract price ultimately, right? That's the
Correct.
and that's
Yeah, if you were to look at Bed Bath and Beyond right now, I would venture to say, based on what I'm seeing here, you'd see 140% or better implied volatility on that option.
okay. So we do have some trade candidates for tonight, and then the real earnings season kicks off. We found that it used to be Alcoa was the official start of earnings season. We found that Fastenal was a better representative of that. So Fastenal reports on the 10th, I believe, and so this is the 8th. So we're just approaching earnings season. We do have a good trade teed up for HELE and potentially Acuity. We're not going to trade Bed Bath and Beyond based on what Mark just said. It's just not there, right? There's no advantage in the Bed Bath and Beyond. So that's what we're offering, is that filtering and choice of good trade candidates, and then choosing the best trade strategy for it. And again, we're kind of excited about the new ones here that we're going to be rolling out. I think it's going to help us, open up more opportunities for trade candidates, and then optimize ultimately the profit as we trade these earnings trades. So it's pretty cool stuff. Any other questions anybody has? There's been some great ones as we went along here. We tried to address them on the fly.
And I'll address Dale. Dale had asked a question earlier. Yes, we do back tests. So what I do is, if you notice on my spreadsheet, there was a tab called snapshot. I take a snapshot before earnings, then what it did, and then we look at it and back test. The problem with some of these back testing, people look at it and say, oh, geez, in Thinkorswim, it's called on demand. The problem is, when you do that type of back testing, the implied volatility is not there for you. So how we are back testing is we're looking at historically what happened for us during earnings season and applying that going forward. So we look at a trade prior to taking it. Where was it at? What was the setup? And we take that information and we analyze it, and then we use that going forward, is basically how we do it.
Michael's asking about, will entry dates vary? I'm not sure I understand. I mean, for earnings trades, we have a confirmed earnings release date and time. It's either going to be, say if it's today after the close or tomorrow before the open, we treat that as the same, and we will be taking that position before the market closed today. And we typically wait until the last hour of the session before we put the earnings trades on.
So yeah, the trades that would be today would be anything reporting after the bell or before the bell tomorrow would be the trades that we would take today. Now, expiration dates may be different. We'll look at what the cost of the options are and those types of things. I was talking to Dean earlier. There was a trade that I was looking at in which it was an expiration this Friday. It was kind of a binary trade, but if you went out a week, it was the exact same price. So why not buy ourselves some time to be able to let the trade work for us? So if the numbers work out, there could be a variety of expiration dates.
And then the exit dates will vary, right, based on how you manage to trade, and whether you choose as a trader to hold some of them, you dump part of them like we talked about, and maybe hold them for a follow-on move, or if you choose to just wait for the event and then get out.
And an example would be, we put on a trade earlier on this on NAV. I believe you exited it pretty quickly on what it is. I actually held the one side of NAV. I'm in it still. Doesn't expire until the 17th. It was one of those where we did a couple different expiration dates. And it's right now it's sitting at me up 165%. So I got a trailing stop on it. I'm letting it go. If it keeps running into expiration, great. If it starts pulling back, it'll sell it on me. So it's really a matter of how you want to trade and how you want to manage your trades.
And how to phrase it. And there was another earnings trade, GES, right, where you dumped it early and I held on to it. I ended up making a lot of money on the fall through.
Exactly.
So,
But the funny thing is, if you look at it, and Dean and I keep separate spreadsheets, but our results are, even though we trade differently, they're pretty equal from a perspective of where they are.
right.
You know,
It
he
kind of
wins on
washes
some
out. And
that
the
I
whole
lose
point
on,
is,
and I win on some that he loses on. So,
and it's a good point, because that's going to happen with folks following along with the service, right? Nobody's going to perfectly replicate anybody else's results. The key is finding great candidates, great pricing, and then managing them, right? And the results, you know, if you follow roughly similar approaches, should wash out and be pretty close.
yep.
All right. Well, so that's really what we had to present for today. We do, you know, I opened this up, and we got several guests here who are not current subscribers to the earnings trades. And what I'm gonna do is I'm gonna follow up with an email to you with an offer if you want to participate, follow along. You know, the pricing is a little bit different because some people have the existing stock and option picks, the swing trades that we take. And if you add this to that service, you get a little bit of a discount for a bundle. If you just want the earnings trades as a standalone service, it's a little bit more, but still a good value. So, you know, the CRM software I use will figure that out, and we'll send out a note, you know, whether you have the existing service or whether you want to add this, or you want to just do this standalone. It'll give you an offer and a fair price. And, you know, if you want to join in, we got some trades probably coming out tonight, and then we're going to jump into earnings season proper, and there'll be a ton. And there's a nice comment from Dale. Dale's been around for a while, and he says a great group, right? It is a, you know, a dynamic and very fun and supportive group, sharing ideas and stuff. And he makes a comment about paper trade. You know, if you're a little bit nervous or new about options, and particularly adding sell strategies, nothing wrong with starting out. You know, you're like really intrigued, I want to check this out. Nothing wrong with following along to start with in sim mode. Your fills won't be perfect, you know, perfect real world. They'll be a little bit different, but it's a good way to get your head around it. Make sure you can, you know, follow along and execute the trades correctly, right, before just putting real money on a line, making a mistake, and getting stung. And Miles wants to see the spreadsheet again. And Bill's seconding Dale's comment about being a great group. Well, that's awesome. And I will email out a link to the recording, and I'll also post it in the earnings section for the existing subscribers. Yeah, Dale's echoing the paper trading. It really just gets you competent and comfortable in executing the trades and then in managing them. And Al's asking, how do we deliver these? What we do is we post them on a secure area of the website, so only subscribers can access it. And then we send out, you know, notes pretty much daily saying, okay, the trades are up, right? Here you go. So they're posted on a website, and you can see the details of the trades.
And we try to get them up at, 2 o'clock Eastern time as a preliminary. These are the trades we're looking at. And then hour before the close of the market, we'll post them as final. Those are the trades that you can execute on.
Yeah. All right. Well, I think we're going to go ahead and wrap it up. Hey, thanks everybody for joining, for your interest, all your questions. It was good. And we're just excited about this. Looking forward to rolling it out. And again, if you're not a current subscriber and you did sign up for this session, you will get an email pretty quick with an invitation to come check it out. And then for everybody, I'll get a link out to view the recording and a copy of a PDF of this presentation so you can study it in more detail. All right. Well, hey, thank you very much, Mark, for your help here. And I thought you did a great job in explaining this. And thanks everybody for participating. And hope to see you in the earnings trading room. We do have a trading room in the mornings, Monday through Thursday, to review the current trades and share ideas and stuff like that. All right. Take care. Trade safe. Whatever you do, use risk control. And keep the winners big, losers small. And we'll see you at the next event. All right, bye-bye.